When compared to traditional open-end funds, ETFs have low operating costs, greater transparency, flexible trading, and better tax efficiency. And although ETFs have their drawbacks, many experts agree that the pluses of ETFs overshadow the minuses by a sizable margin. So what are some of the best exchange-traded funds you can buy right now? You will find out in this video. What's up guys? Welcome back to Glory Investing Show. In our today's video, I'm going to tell you about the top 5 ETFs you should invest in. However, before we go any further, make sure to subscribe to Glory Investing Show and don't forget to hit that bell icon so you never miss any updates. And just to let you guys know, if you would like to buy some awesome trading merch, check out our website. There's a ton of different things you can purchase. You can use the code ADDICT at the checkout if you want to receive a discount. Now without further ado, let's get into this. QYLD is an excellent choice for individuals seeking cash flow from the stock market. The QYLD is a global S Nasdaq 100 covered called ETF. They can provide a constant share price while yielding a higher than average dividend through its sales approach, which eliminates a lot of the risk and cash flow issues associated with dividend companies. Take a peek at how QYLD works currently. QYLD is a mutual fund that invests in equities and offers call options on certain stocks in exchange for premiums. The collected premiums are dispersed to shareholders after each month. The ETF's price is consistent, with an average actual range of only 0.8%. Over the last 5 years, the company has delivered a small but healthy 1.18% compound annual rate of return and a dividend yielding 10% on average. Many individuals invest in QYLD since it pays dividends for premiums, which is preferred to the standard dividend system for several reasons. Dividend stocks, for example, frequently encounter issues as a result of their high payout ratios, and they're now engaged in a legal dispute. They are ill-equipped to deal with a negative outcome since they give out more than 80% of their revenues in dividends. This is not an issue for QYLD because the underlying firms are not included in the dividend financing. Another advantage of QYLD is that they deal with high-quality Nasdaq 100 stocks that have increased by 221% in the last 5 years. QYLD does not respond significantly to market changes, but such a well-performing underlying is typically preferable to the steady and frequently falling character of regular income investments. The current value of Global X Nasdaq 100 cover call ETF is $22.83 approximately. Rather than supplying the entire basket, SPHD selects the US equities market. These include the 50 least volatile names selected from the S&P 575 top dividend-paying equities. The portfolio has a slight tilt and favors typically defensive businesses such as utilities and basic commodities. The included stocks are designed to be the least volatile, high dividend yielding stocks. The first thing that comes to mind is, how does SPHD work? The S&P methodology does not limit consistent growth or more significantly stock price increase. An owner in the Invesco S&P 500 High Dividend Low Volatility Portfolio ETF, SPHD, is likely to be looking for yield and earnings. The S&P 500 index tries to maximize income while taking into account the expected risk aversion of its owners. Invesco's high dividend low volatility portfolio also helps in this area by restricting the proportion of individual stocks. If you want to invest in SPHD, you should know that it is quite beneficial since it plays strategically. SPHD would beat the market since the majority of the companies it focuses on are purely defensive. In times of economic uncertainty, these stocks, as well as consistent dividend payers in general, will benefit from sector movements. This might explain part of the SPHD portfolio's recent high performance. SPHD now consists of 19.1% utilities, 18.9% consumer staples, and 10.7% healthcare. The S&P 500 blue chip portfolio is made up of 48% blue chip stocks, 42.3% large cap stocks, and 37.5% mid cap stocks. The first 48% screams defensive, and it is typical of dividend-paying equities. Following that are more cyclical industries such as commodities and property investment, information technology, and energy. Let me tell you that the current value of the Invesco S&P 500 High Dividend Low Volatility ETF is about 43.36%. Next on our list is the JP Morgan Equity Premium Income ETF, which is an actively managed product that earns money by selling options on large-cap equities in the United States. The investors invest in low volatility, high value equities in the S&P 500 and sell options on those companies to earn extra income. Because JEPI was introduced in May 2020, there is only a small amount of performance data available. An actively managed fund is in the end a wager on the manager's ability to outperform the market. The JEPI earnings strategy aims to mix stocks with options to create a balance between income, capital growth, and risk. In addition to monthly income, JEPI aims to give a major share of the returns associated with the S&P 500 index with reduced volatility. JEPI developed a higher quality, lower beta index of US big cap companies with fewer volatility profits and stock values using basic bottom-up analysis. The premiums are then used to create revenue by selling index options against the long-only portfolio. While investing in JEPI, the investor receives the services. These services of more than 20 research analysts and over the 30-year specialized procedure to search attractive equities throughout sectors. It allows us to avoid the length risk of greater bonds and the quality risk of higher yielding equities. It starts selling call options every week to adapt to changing market conditions. It sells call options every week to respond to changing market situations. The JEPI can deliver more income at a time when investors are most vulnerable to price fluctuations. It pays out 100% of the time, distributes all money through dividends and option premiums as vouchers rather than profits so that no capital is repaid to owners. JP Morgan Equity Premium Income ETF is now worth around $106.50. The Global X Russell 2000 Covered Call ETF was established on April 17, 2019 and is based in the United States. RYLD Fund is a publicly listed exchange-traded fund that was founded and is administered by Global X Management Company LLC. Investors invest in stocks of firms operating in a variety of industries, both directly and through derivatives. The product intends to offer investment outcomes that are typically consistent with the price and yield performance by using a representative sample approach to follow the performance of the CBOE Russell 2000 Buy Right Index. The investors invest a minimum of 80% of their total capital in component stocks or investments with economic characteristics that are equal to those of securities. The statistic measures the performance of a hypothetical portfolio comprised of companies from the Russell 2000 index.
Great chart here that shows the outperformance of the Russell 2000.
RYLD pays a variable payout dependent on the profits it may obtain through options. Since its debut, the average amount has continuously increased and the TTM yield is 11.55%, which is great. You don't need to be concerned because the payout is derived straight from option premiums. One of the reasons this fund is preferred over other covered call funds is that by monitoring the Russell 2000 index, it is possible to write more profitable call options than the more popular S&P 500 index. This ETF is now worth $25.39 approximately. DIVO is also referred to as Amplify ETFs. Its ETF portfolio has more than $4.5 billion in assets. The ETF structure, according to Amplify, encourages investors via efficiency, transparency, and flexibility. Amplify ETFs provide more investment choices for investors seeking growth, income, and risk management techniques. It is purposefully designed to provide high levels of total yield while being risk-adjusted. Capital Wealth Planning, an ETF sub-advisor, actively manages the fund. In today's low interest rate market, many financial advisors are finding it difficult to generate income. As investors look optimistically to the future, investor interest in investing in DIVO has risen considerably in 2021. As a fundamental equity income strategy, we think DIVO fulfills the desire for income with our guidelines approach to holding high-quality firms and tactical covered calls. DIVO's current distribution rate is 5.28%, with an SEC yield of 1.48% for the next 30 days. The fund distributes its earnings on a routine basis. DIVO has a 5-star overall rating and a 3-year Tribune rating based on risk-adjusted performance among 43 variable income funds. Amplify CWP Enhanced Stock Dividend ETF is now worth almost $37.07. Well, that would be all for today's video, and thanks for watching it. If you liked it, make sure you give it a thumbs up and share it with your friends. And also, if you have not subscribed to Glory Investing Show, subscribe to it and press that bell button so you'll be notified each time we upload an interesting video on this channel. And while you're here, click to watch one of these 2 videos that are appearing on your screen. We'll see you there. Take care and stay tuned.